Hi, my name is A. Dhanvi Sriram and the company I have been allotted is Tech Mahindra. All the values in this analysis have either been obtained from authentic websites or have been calculated using the most appropriate available formula or model. Any discrepancy or disagreement of the values presented with that of the original values of the company is sincerely regretted. I have adopted fundamental analysis, ratio analysis and valuation techniques to analyze my company. In the fundamental analysis, I have analyzed the company's behavior during the Great Recession. The IT sector to which my company belongs has been analyzed using the Porter's 5 Forces framework, and the company as such was analyzed using the SWOT analysis. Here is a schematic representation of the Porter's 5 Forces analysis of the company's industry. The company did an exceedingly well job during recession managing its S&D, that is sellings and distributions expenditures, very well. The recession created transformation opportunities as people wanted to look for newer lines of services in which Tech Mahindra were enablers. Tech Mahindra transformed itself and offered newer services to satisfy the customers to a greater extent during the recession. The Satyam merger proved very helpful in broadening its base to the enterprise sector. Tech Mahindra expects to touch $5 billion revenue by financial year 2015. Coming to the ratio analysis, it is always good to have a high EBITDA margin, and Tech Mahindra's performance has been on par with its competitors over the years. Regarding the asset turnover ratio, it can be said that a high asset turnover ratio is always good for the company, and we find that it is comparable to its peers over the years. The current ratio reflects upon how well prepared the company is for an emergency situation in which its current liabilities become due, and usually a current ratio of 2 or above is considered safe. And we find that the current ratio of this company, although comparable to few of its competitors other than TCS especially, still needs to be improved upon a lot. The quick ratio is similar to the current ratio, only that it is current assets minus inventory divided by current liabilities. The quick ratio below 1 is considered as red flags to the most of the companies in many of the industries, but we find that here with our company, the quick ratio, which is 1.02, is decent enough as a ratio. The P by E ratio tells us that the P by E actually stands for share price divided by earnings per share. This ratio tells us how many years a company will need to earn back what investors are currently paying for the stock. It is generally high for companies considered to have huge growth potential and low for mature or unexciting companies. Our company has a high P by E ratio, indicating that it is in growth stage and still needs to improve upon this ratio to get it down to a lower level. The EV by EBITDA ratio is proportional to the amount the other company has to pay in order to acquire this company, and we find that it is reasonable enough but very less when compared to TCS. The debt to equity ratio is a measure of the company's leverage. A value of 0.26 indicates that the company's capital structure is largely dependent on equity and less dependent on debt, which is actually a good sign. Here, the WACC was calculated using the RM, RF and beta values. A beta of 1.05 for our company indicates that the company is volatile and it is much responsive to the fluctuations in market. All these values have been calculated for the year 2013. The intrinsic value of the company's share price is calculated using the FCFE model. The FCFE model is most suited as the cash flow to the firm is positive and the company's debt levels are stable over the years. We can see that the intrinsic value of the share price is 1779.48 INR as obtained by the FCFE model, whereas the current market price is 1523 INR, indicating the company's stock to be clearly undervalued, recommending a buy for the company's stock at the current market price. The net sales or revenue of the company is expected to increase over the next 2 years, considering the earnings per share growth statistics. The ratio analysis says that few of the ratios are decent enough, but on the whole the company needs to improve a lot on many of its important indicators as the company is in growing stage. The equity valuation is based on FCFE model and says that the stock of the company is undervalued and recommending a buy at the current market price. Thank you very much.